And we're rolling. Good morning. Good morning. Welcome to another episode of Momentum Monday. Today it's Monday, December 16th. This will be the last one of the year. This is, we got Christmas coming up next week and then New Year's the following week. So we'll pick these back up in the new year, but we did want to do one more before the end of the year just to talk about some things that are going on specifically this week. We've got the Federal Reserve looking at interest rate cuts on Wednesday. We've got some other things that'll come up, so we'll hop into that. But I'll throw it at Matt for the fine print.
Yeah, I didn't have my full cup of coffee, so I've had to.
I hate that for you. I did. This is empty. This is just for show right now.
The cold drink here. Yeah, keep in mind that anything we talk about is not to be construed as actionable investment advice. Always reach out to us about your specific situation so that you can make the best decision for the retirement plan, the income plan, the investment plan that we have created for you.
Yeah, so I'll do some show notes here right at the top as well. We have had some people reach out saying there's issues accessing the video with the current tool that we're using. It's a company called Riverside. Helps us record this and edit it pretty quickly. So it's a good tool for us recording the actual podcast and then editing it. Apparently not such a good tool for distribution. So starting with this podcast today, you'll get a YouTube link and we'll continue that on through next year. We are looking to potentially kind of have a different looking set at the beginning of the year. So we'll see how that works out. But distribution through YouTube is going to be probably better for most people. And, if there are issues with playback or you can't access the video or something like that, please let us know. We always want to know that stuff so we can help you troubleshoot it. But with that said,
and there will be, what we've been chewing on is essentially we have our Momentum Mondays, which is really geared towards our existing client base, and then also doing a longer form that's maybe not revolving around just market movements specifically, but about other interesting topics as well that can add value, in the financial planning space and business development. Yes, investment strategy. So that's some exciting things.
Yeah, financial concepts, potential interviews, things like that. Yep.
Excellent. Well, let's get going.
So let's rewind the financial tape. Let's look at what happened in the markets last week. You've got the S&P basically flat, down a little bit. NASDAQ up 1.5%, Dow Jones down 1.2%, Russell down 1.96%, almost 2%. When we look at commodities, gold down 0.44%, silver having a really rough week last week, down over 4%, 10-year bond down 1.3%, Bitcoin up over 5%. And then we look at those on a 1 year. S&P still up 29%, NASDAQ up 31%, Dow Jones almost 20%, Russell almost 20%, gold over 30% year to date, or not year to date, but 1 year. Silver up 27%, it lost some ground because of last week. 10-year bond up 0.78%, and Bitcoin up almost 150% over a 1 year period. So some of the things that happened last week in the market we can kind of talk about is this idea of this concept that we have talked about before called breadth, B-R-E-A-D-T-H.
Breadth.
It's hard to say, breadth. It's this idea that, when you look at stocks overall, because the S&P is made up of, it's called the S&P 500. There's more than 500 companies in the S&P 500. I don't remember exactly how it is, but the same is with the Dow 30 or, the NASDAQ. When you look at these players in the market as a whole, you want to see things trending in a positive direction. So anytime you get large pushes that brings the market up, you want to make sure there's a lot of participants participating in that. The example that I would give is the Magnificent Seven that happened, was that last year, 2023?
End of
2024. Yeah. Yes. So you had essentially 7 stocks that pushed the indexes up pretty good, but not a lot of the other stocks were participating in that. And then that sort of flipped to where more stocks started participating in it, and it was considered to be sort of a healthier market because more participants were taking part in that. And so last week what happened is It appears that you had some of those participants kind of struggling last week. So there was a kind of a pull and push and a back and forth between, is this a bearish indicator or is this a bullish indicator? I think we ended the week off with it still being in that bullish territory. I don't think any significant damage was done, but it was interesting to see from a standpoint, kind of the tug of war, the fight between some of the stocks. We had kind of a, the indexes don't really, portray that, but we had kind of a pull and tug last week. You had some down days, you had some up days, you had some days that started up and then ended down. So it was kind of all over the place. We'll see what this week holds, especially with the Federal Reserve, having a decision to make on Wednesday.
Yeah. So they're cutting again. It looks like a quarter point, which would take the Fed funds rate to right at 4.25. I believe is 4.25 to 4.5 is the range. And,
yeah.
I think that the next exciting, or rather the next where the anticipation is building now, is how quickly do treasuries come down in interest rates, also appreciate in price. There can be several factors that are going to go into play with that, but that 10-year treasury is really what's holding your financing for durable goods still up high, cars and mortgages specifically. So
yeah, I mean, I sent you an image. We can pull that up. I'll put it on the screen for everybody to see. But when we look at inflation, because that's the biggest thing, well, it's one of the biggest things. So we talked about all year, the Federal Reserve has a dual mandate of price stability and full employment. And we have really neither right now. And so they're kind of in this weird spot where they're trying to figure out what to do next. So if you look at where inflation is and isn't in the past 12 months, obviously the biggest culprit is auto insurance. Everyone has seen their auto insurance skyrocket. I've had several conversations with family in the past week about insurance rates, car insurance rates specifically. And so I would say this is the caveat here. This is the kind of helpful tip. If you have not shopped for car insurance in 3 or more years, I would do that. I would get quotes from at least 3 different insurers. Even if you have a broker that can quote different insurers, I'd go to a completely different shop. You can get quotes online from different companies. There's all these companies popping up. The other caveat is if you have State Farm, Allstate, or AAA, even if you'd had the policy for 6 months, I would shop around, because those are historically what we've seen is those are on the higher end of the spectrum. But
we're seeing the same thing with home insurance and both.
Yeah, not to the same extent though as auto.
I mean, yes, well, because you're going to have you're always going to have more claims on auto than home. Yeah. But the average age of vehicles on the road continue to increase. I think we're at 12 and a half years. So the trend is up and to the right. And until more people are able to purchase newer vehicles, the insurance is going to keep going up, because the longer you drive a vehicle, the chances of you having a claim on that vehicle are high. And then also, because you could argue, well, it's the hours driven, not the vehicle you're driving. So, I mean, you could argue that. But
well, the other thing that's happening is the car manufacturers are in trouble. And so if you get in a situation, Saturn being the most famous example of this, where the car manufacturer goes away and you're still left driving vehicles, the insurance on those cars are going to go up because you can't repair.
That's
them.
right. Yeah. So that's I guess would be the biggest aspect of it. And not even people like Saturn that have gone out of business, but also car manufacturers that no longer make those vehicles. For instance, Ford no longer even makes sedans.
Right.
So
the models, the vehicle models.
Yeah. The cars. And so same thing with Chrysler. And so you're getting in a situation to where even if the manufacturer still exists, that model is no longer made, and there's lots of them that are out there. Yes, makes it more difficult. You got to
or Jaguar that's going all electric. What does that mean for service on vehicles that they've already sold? Is that going to get more expensive? I mean, it's
sure.
already expensive.
Yeah, because your service stations, if you go to a Tesla service station, it's a completely different layout than your standard GM service station.
Right.
So yeah, there's lots of things going on that. Same in the home insurance without new stock coming on the market. And that's really the biggest driver there is new stock coming on the market, because the age of the home specifically coming around roofs, right? The insurance companies are not, their risk pool is getting denser in the probability of claims. And so insurance costs, they're going to go up. And until there's new stock on the market, and until, the technology, not just with your Teslas that are out there and your Mercedes, but as your technology for highway driver assist starts getting in the hands of more and more people, which is difficult to do when they're driving a 12-year-old car. The new cars now, really any manufacturer you go to, they're going to have blind spot detection. They're going to have auto brake. They have a lot of the safety features that keep you from making mistakes and causing accidents.
Yeah, but that's been 4 or 5 years now.
Yeah, but if the average car is 12 years old, the average driver doesn't have those technologies, because that would put the vehicle, at 2012?
Yeah, I guess so. I mean, I was reading the other day that a 2000, I guess any model year, 2000, specifically Toyota Tacoma that I was reading about, qualifies for like antique plates next year.
Antique tags, yeah. Yeah, so that'll change if the economy continues to improve. But some other things to look at. So if we look at this inflation chart, you see that most of your inflation is going on the service side. I can just see that by looking at it. We have personal care, pet care, medical care.
Yep.
It's all service driven, which is, you're going to have that demand for higher wage for the person providing that service so that they can continue to pay their bills and their higher car insurance rates, et cetera, et cetera. Now, what's interesting, if you look at the bottom end where you see outright deflation, year over year price declines. Gas is kind of volatile, so that, look at rental cars, look at electronics, toys, and then look at used vehicles. So even though rates are high, used vehicle prices continue to go down quarter after quarter over the past 2 years since that COVID high. So I
think they kind of have to, because you don't have any vendors or institutions doing 0% financing on used vehicles. I mean, these interest rates are 8 to 10, 11, 12%.
The prices people can't pay for.
The prices have to come down. Whereas your dealers selling new vehicles, whether you think about Tesla or Mazda or any group of them, there are lists that come out monthly. You can follow people on Twitter that keep track of that. These 0% financing deals from dealers, they have inventory. They got to get rid of it. That's why they're doing the 0%. And they can push these things out, and they can say it's ending next month, and then they can, push it out another few months or whatever. But you can't do that on the used car side. So, yeah, that's not surprising that those vehicles are coming down in price.
And I will predict that over the next 24 to 36 months, you're going to have Nissan's most likely going to be bankrupt. Toyota will have a significantly reduced presence in the U.S. Honda may be forced out of the automobile industry altogether. You're going to have major players that people see the dealerships now. They see the cars drive. People are still buying it, but it's going to be pretty quick to where you're going to have a lot of these manufacturers that are just going to have to completely go out of business, specifically in the U.S. That's going to push prices down. And then you have the likes of Ford, GM, and the Chrysler Group, whatever, the Stellantis, that are going to be forced to have to compete with Rivian, Tesla, Mercedes on electrification.
VW.
And these vehicles are, people don't understand. When you look on this chart, electronics is almost perpetually deflationary. And vehicles are now moving from being a durable good that requires constant maintenance and care to maintain its functional ability to just like your TV. Yes, you have to change the batteries in your remote every now and again. Yes, the screen may go out on your TV. But when you buy a TV, you have a pretty high degree of confidence it's going to work for the next 10, 15 years. And the technology behind that is improving at a rate that is hard to comprehend. So you're going to have prices continuously go down on these electric vehicles. And that's going to put a lot of pressure on your standard manufacturers to compete with that. And we will have an inventory glut at some point, and then interest rates drop. That may help it. But, vehicles especially used vehicle prices. You know, people that know us and known us for a long time know that, you know, I guess now would be more than a decade ago, we were the youngest endorsed local providers for Dave Ramsey's investment referrals and recommendations. And I think we were 7 or 8 different locations in the South, from Southern Arkansas, East Texas, North Louisiana, North Mississippi, Central Alabama, et cetera, Columbus, Georgia. And people have long mocked Dave Ramsey about the go pay $1,000 for a car, because he's like hasn't updated his recommendations. And I think that he may be ending up having the last laugh on that, because if things keep going like they are in the automotive industry, a lot of these vehicles you may actually be able to go get for $1,000, $2,000. So, you know, which I guess is a good thing, but we'll see.
How that's going to shape
I predict it. $1,000 car. I predict it. If not, I will donate
$1,000.
I will donate $1,000.
I mean, you can get $1,000 car. I think the example of the electronics is one that a lot of people point to, because, you know, in recent memory, television prices have dropped like a rock. You can go easily get a 60+ inch television for $300. I mean, even when it's not Black Friday or something.
Oh, I saw a Walmart. They're not even, I don't even know. It's like the size of a wall. It's like you can build a wall with a TV for $200.
Yeah, I'd be interested to see what that technology is. But yeah, I mean, a standard television that everybody has in their living room. Now, you can get into the higher end when you're looking at the TVs that double as like galleries and art pieces and stuff like that. You can get into or the outdoor TVs are still a couple $1,000s if they have that, you know, anti-glare stuff for the sunlight. But just a traditional TV that everybody has in their house. Yeah, there you go. I think this was a couple $100. So that's the biggest example that people see, like it right in front of them. I don't know how well that translates to electric vehicles though, because they're I mean, I see the similarities, but I could argue against it as well, as far as battery technology being that it's not user replaceable necessarily. And so the cost there is a little bit more, because it does require some semblance of speciality. You have to take it somewhere to get it, you know, fixed. But, you know, as that comes down, you know, is that going to come down? You've got manufacturers and miners and energy companies in this country opening up with, you know, there's a big place in Arkansas where they're doing mining for these minerals that have to go in these batteries. Yeah. So will that come down over time? Probably, yeah. But
here I'm gonna blow your mind. Watch this. So,
my mind.
When your Chrysler van, let's say that the engine wears out.
Yeah. Well, yeah.
If the engine wears out, what is the value of that engine? Its value is only the scrap, right? Whereas with batteries, if you think about just the battery you use to start your engine, it essentially has a base value that it's never going to go below, and it's a closed loop environment. Every battery that's in your car and every standard car that, you know, cranks the engine has come from a closed cycle of batteries that have been recycled over and over and over again. So now, if the battery in your electric vehicle stops working, it has a base value, and that base value is around $8,000 to $10,000. And the reason for that is because when you recycle the lithium iron phosphate batteries, you get a higher purity each time it flows through the loop than you do from your virgin minerals being converted into lithium iron phosphate, et cetera, et cetera. So, you know, yes, if a battery goes out and you have to replace it, most of them have like a 10-year warranty, but even so, you're going to be looking at a situation, instead of getting a $5 credit at AutoZone when you turn in your alkaline car battery, it's an $8,000 credit you're getting as you.
Yeah, but how much is the battery?
Well, I mean, that depends on how many.
Well, that's what I'm saying. The battery now versus 5 years from now, you're going to be in a different situation, potentially. It's going to kind of normalize that cost and potentially start to bring it down beyond where it is now. But now that's kind of some people's number one concern.
It's the cycle rate, though. Like you can make what's the high Lucid.
Yeah.
So they are like over
0% financing.
They're $150,000.
0%.
So they have, when you look at their battery technology, they're really trying to reach for the stars, but that's not as important as the durability, the cycle. How many times can you cycle a battery? That's really what matters.
Right. But it's also this concept of becoming more accepted in the culture and the zeitgeist. There's Teslas everywhere, but the number one concern that I hear everybody say when you talk about Tesla or any electric vehicle is the battery. That's their number one concern. So
so just YouTube, how long do electric batteries last? And you'll be surprised. There are, you're looking at 500,000 miles. The average vehicle dies 7 years or 250,000 miles, whichever's first. Generally,
that's when it goes. Saying they have to do a lot of education about that, because there's not many people that. When you think about an electric car, you think about the problem with the batteries, and then you see these examples in cooler climates where people have problems with Teslas, and you're not seeing that on a 30,000 foot view, that those are actually very small by percentage, and most of those are people that don't have home chargers, and so a lot of this can be mitigated with the weather and all this kind of stuff. But we can get on a tangent about this that I don't think is productive. But
it's interesting. So one last thing on
I don't know if it's interesting to anyone else.
On the technology aspect of it, I would just simply, you can do a lot of research. You can, really get in depth with trying to figure out how all this is working. But the simplest way that I've told people and looked at it, when you look at the efficiency and the durability of electric motors, just think about the fan in your house. I would say most people listening, there's a fan in your house that's probably been there for 20 years and it still works when you turn it on. And think about a standard gas engine that you interact with as much as you do your ceiling fan in your living room. Chances are that ceiling fan is going to outlive any combustion engine that you're using, save from, maybe some of your diesel engines. And that's because of the frictionless, the efficiency of the motor. Tesla back in what was Nikola Tesla. This has all been proven.
I don't think there's any issues around the motor. I think everybody pretty much understands that. I think it's the battery, specifically the battery part about that. But as they become more common, I think as Tesla already does the power walls, which is the whole home sort of battery that you can run as those become more prominent, probably as the price falls, as solar panels fall and as these battery packs fall and they become more commonplace, I think people will start to kind of understand how it can. I don't know. Maybe I'm wrong about that, but when I talk to people about, hey, look at an electric vehicle, that's a concern that most people say. It's like, what do you do with the battery? What do you do with the battery? And so they got to figure out
and it's a learning curve too.
Yeah, that's right.
It really
any with new technology, because at this point you're still kind of an early adopter, I guess. Maybe not early adopter, but you're still, they're not. I don't know. Maybe Teslas are everywhere. I don't know.
They drive themselves.
Are a lot.
People don't. When you wrap your mind around the potential for such innovation in this country, especially now we're looking at.
In certain areas.
Well, any AI driven, anything where you can. It's going to be amazing. We went from, the millennials are the last generation, or actually they're the only generation that, unless you go back to people that were born, which they're all dead now, but people, I think about my grandmother that was born 1917 and people before that, you're looking at the millennials are the most recent generation that knows what it's like to live pre-Cambrian explosion with some type of technology. So we grew up knowing, we had corded phones. A lot of the families still drove older vehicles that used to run on leaded gas before, it's everything switched to unleaded. And now we've gone from being able to video conference and FaceTime and pay with your phone and all these technologies, self-driving vehicles, watching companies going into space on a regular basis.
Private companies.
Yeah. So millennials are really kind of the last ones to taste what it's like to grow up in that middle of what, again, I'll use that Cambrian explosion as an example. And I just really think it's just getting started. And that kind of takes us to the market and, how you really can't look at what the news is talking about in relation to all-time highs, because we're there.
Yeah, but that's not. Yeah, that's a good point. That's another thing that everybody gets kind of up in arms about is all-time highs. Whenever you hear that being thrown around, your immediate reaction is,
it's going to come down.
It's going to come
It's
down.
coming
Yeah.
down.
And it's just not historically the case. I mean, you can have all-time highs for a long time if the underlying trend is strong, which by all accounts it is.
And the trends are, so what is in favor of continued market appreciation? There's so many things. A nice interest rate environment, which it seems like we're getting closer to.
Well, I think the interest rate environment,
neutral rate, I guess.
Well,
would be,
yes, not back to where, So talking about that, going back to the whole reason we brought up this inflation chart is that this is what the Federal Reserve is looking at. They want price stability, but they also want full employment. Unemployment is like 4.5% or something, maybe a slightly higher than that, and it's kind of,
if you believe,
increased. Oh, well, that's true too. Yeah, they manipulate the numbers for sure, but that's what they're looking at to say, to kind of figure out how to do the dance that they have to do. And so what the Wall Street Journal reporter Nick, I'm going to butcher his last name, but Timiraos or whatever, I don't know how you say it, but he's basically the secret mouthpiece of the Federal Reserve. And so he makes the argument in the Wall Street Journal today in an article that they kind of have a balance to take, that maybe they'll cut a quarter point this week, and that will be maybe the last one for a while. They're not going to be in a hurry to cut it. And so a lot of people get into this habit of thinking that price stability and rates need to go back to what they were. And I don't think that's going to be the case. I think we're going to be in a higher interest rate environment than we have been for the past decade. But I think it's probably okay.
Yeah, because it's not when you have, so there's several things that are going on. So when you're in kind of that Keynesian moment in a business cycle, to where Fed printing and government spending.
Explain what you mean by that. Keynesian. This is an economic outlook.
The Keynesian philosophy on economics is really placing a lot of importance on the role of government to create economic activity, to stabilize downturns, and to increase productivity vis-a-vis spending.
And the opposite?
The opposite would be the Austrian side, which is productivity comes from savings and investment. So we live in a mixed economy that has both of those things. And so if we're really moving in a direction of deregulation, which means efficiency, how quickly can capital flow to investments? Large amounts of capital. I'm not talking about somebody's $100,000 401k. I mean, how quickly can $100 billion? I know SoftBank just announced a $100 billion investment in the U.S. They were down at Mar-a-Lago. It's I'm not even going to try to pronounce his name.
Well, you're going to start seeing a lot of that because he's talking about lowering the tax rate for companies that invest in the US.
Efficiency. How quickly can we get capital deployed? When that capital is deployed, will it produce more goods and services than the amount of money that was used to make the factories and the facilities? And of course, investors are going to make sure that that's the case. And it's not perfect, and then we look at, low taxation, that kind of goes in with deregulation, but also reduced government spending. So
potentially,
So if we can reduce government spending, that's going to go a long way towards helping the Federal Reserve do that dance. And maybe even we get to a 3% neutral rate, people can get compensated for their savings, which will encourage continued savings with the banks, which gives the banks more dry powder to lend. And it will give more dry powder for future downturns. So it's interesting. There's a lot of moving variables, but my whole point in saying all of that is right now, I'm not focusing too much on what the Fed interest rates are going to do, because if you have the right economic environment, the private sector can create significantly more money than the Federal Reserve can in the system. And if that's coming from efficiency, productivity gains, savings, and investments, then that's true wealth creation. And it doesn't really matter if the Fed is at 3 or at 4. I think what matters the most is that the Fed getting to a neutral stance to where they're not trying to slow the economy down and they're not trying to speed it up. And, that's kind of the Goldilocks period. And we've seen that happen several times. I think the two most important time periods to look at would probably be after World War II and then also the 90s, where significant economic growth and the Fed was more or less in the back seat. And I think that Jerome Powell would probably love to be, out of the public view and catching so much hate constantly, but we'll see.
Par for the course. I mean,
Yeah.
I don't think you can care about that when you're in that job.
But it's much bigger than everything's at all time high. Number went up, ergo number must go down. And I just caution everybody that we're not in that environment. I don't think.
The biggest argument there is valuation, is companies and the high valuations they have historically to what they've had. But there are arguments to be made for why that is as well. I mean, you could see both sides of that argument. But we're coming up on 30 minutes, so I don't want to keep belaboring this, but we do have some things coming up next week, or this week rather. Sorry, this week. So we've got the wholesaler inventories, a couple of inventories coming tomorrow. We've got building permits coming on Wednesday, as well as the upper rate limit for the Federal Reserve. The Thursday, you've got existing home sales, initial unemployment claims. And then Friday, you've got some price index coming out and consumer sentiment scores. So the other thing that we want to talk about, and we won't belabor this point because we're going to wrap this up, but what you're going to start hearing about in the news is something called the Santa Claus Rally. We talk about this every year at the end of the year. It's the last 5 trading days of the year, the first 2 trading days of the new year. So it spans across the time. This was kind of discovered by a guy named Yale Hirsch, who passed away a few years ago, but his son still runs his sort of analytical arm called Stock Traders Almanac. They basically have found that it's a positive correlation to greater returns if your returns during the Santa Claus Rally are positive.
For the next year.
For the next year, that's right. Even if they're positive by minuscule amounts. And so that's why a lot of people hype that up. So as we get toward the end of the year, you'll start hearing more and more talking heads and CNBC and CNN and so forth talk about the Santa Claus Rally and its effect. So this is an indicator that we look at. It's not really an indicator we use for trading purposes, but it's interesting just anecdotally. If you see, the end of the year, the first part of the new year, you kind of see the sentiment there or what people are excited about.
Excuse me.
Yeah, can't cut that. So
the carbonation.
We need a burn button, I guess.
My apologies.
So yeah, it's just something interesting to look at, but we'll keep an eye on it. We'll talk about it, in the first podcast of the new year.
And I would also say, so housekeeping real quick, as we're getting near the end of the year, keep in mind, have you done your Roth IRA contributions to the max? Are you able to do that?
Yep.
If so, you need to get in contact with us after the new year before you file your taxes and figure out a plan for that. Same thing if you're deducting traditional IRAs, 401ks, ships done sailed. You can't do that after the end of the calendar year, but start thinking of next year. Can I increase my contributions? Have all of those things kind of front and center as we get near the beginning of next year, or New Year resolutions, getting our budgets in line, which everybody always does after Christmas.
Annual review season will come up.
Yes, annual review
season
season's coming
year,
up. Be
so
prepared for that.
Those letters, those emails about scheduling that time. We definitely want to sit down with everybody. But yeah, good point. Make sure that you are fully contributing, fully taking advantage of that. If you need to figure out kind of what you contributed year to date so far, we can definitely let you know. Send us an email where you need to put money, maybe that you have left over, extra money. If you get bonuses toward the end of the year, we can talk about all that stuff. So please let us know. Anyway, we're at 34 minutes, so this is one of our longer ones, but we'll let you go. Hope everybody has a Merry Christmas. We've got some gifts coming out this week to clients. You should be receiving those.
Are you talking about the infamous pecans?
The infamous pecans, yes. They will be shipped out.
Pecans.
Yeah, however you say it. They'll be shipped out. So we hope everybody enjoys that. Everybody has a good end of the year with family time and all that kind of stuff, and a good start to the new year. And we will
good Christmas.
We will see you on the other side of that.
Yeah.
Calendar flip.
And we're going to have a very interesting first show at the beginning of the year. Cover. Yes, we are. I've got a lot of, I think that what we should do, for years, I know we're wrapping, but for years,
this is our closing
to have an interesting perspective on the market ahead for the year. And then also to see how accurate a stock picker can be. Me and Garrett have always listed a few stocks or funds or ETFs that we think will be the
Oh,
year's
man.
winner. And so we're going to start making that public so that we can both
Are we?
take victory laps and then also face our humiliation at the end of the year. But it's also illustrative on the importance of having a good diversified investment plan, because even people like us that are immersed in this constantly day in and day out, that don't have a crystal ball. So it's more or less learning how to delegate, using data as your friend. But we want to start opening that up to really show people how we're thinking about the market in a little bit more in depth, and also who's right or wrong at the end of the year.
We should say it's not anything that we use for client purposes.
No, it's purely it's purely a kind of an office bet that's gone on for years and years as to who would be right. So and I know CNBC, we didn't copy this, but CNBC does that every year too.
Oh, really?
It's the
winners and losers.
Yes, and they have, like, Kevin O'Leary and all these people come on and they talk about what they think.
That's interesting.
And I think they do a championship for charity. So we didn't copy it from that. It's just something we've always done as to what do we think is going to outperform, and then measure that up against what actually did. So it's very interesting. So enjoy Christmas. Let's wrap it. And any questions, concerns, always email, text, phone call. Feel free to share this video with friends and family members. We appreciate you guys, and we look forward to another outstanding year next year, because this one was a good one. This one was one for the record books. So
yeah, well, we'll end on that note. I hope everybody has a good Christmas, and we'll see you guys on the other side.
Take care.